Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 231. And on this episode, there's a couple things I want to talk to you about. Last one we kicked off the year with PMI savings and how you could reduce the PMI on your mortgage payment. And we gave you the exact recipe how to do that with multiple options. Feedback on that episode was so good, I decided to step into another mortgage hack, if you may. With these high elevated interest rates that people have been acquiring since Q4 of 22 and Q1 of 24, I decided, hey, how can we help people lower their interest rates and save money on their loan? But get this, without having to refinance. So if you bought a home and your interest rate is above 6.875, this episode's for you. So hey, welcome back. So as I spoke earlier in the intro, I really am making a point of emphasis to say, how do we bring value to our audience? How can we help you guys do some things right now when the rate market necessarily isn't in our favor? We've been talking about it's coming, and I'm a firm believer it is. We did an entire episode as to why. But what I want to pinpoint on this episode is, what can I do to help you save money right now that doesn't cost you additional money? Meaning you're not going to pay someone to do something for you. Yes, you could go refinance. Yes, you could take points and buy it down. But as I said, if you bought a home in the last 2 years, last 2.5 years, you're probably sitting somewhere between a 6.875 interest rate and maybe even an 8%. Maybe you refi out of the 8, maybe you haven't, maybe you've got something in the 7s. It just doesn't make sense, right? We've talked about that notion of making sense. So here's another thing. I'm also talking to you people that are in the lock-in effect, right? The people that I've been saying, hey, listen, here's this lock-in wheel. They've got these low interest rates, anywhere from a 2% all the way to a 5%. I'm talking to you as well. But the point of emphasis for this is driven home to the people that want to refinance, but it doesn't make sense for them to do it right now, right? So one of the things I learned back in 2008 when interest rates got to that pivotal 6.75, 6.5, no one wanted to refinance. Matter of fact, it's not they didn't want to refinance. They didn't have the equity to do it. That's what I should say. Leads were never a problem, man. We had people calling all day long wanting to refinance, but they were upside down in their homes, right? So we would do an appraisal. Value would come in at X. Loan amount was at Y, and Y was like 30, 40, 50, 100 grand higher than X, right? You just couldn't do anything. And it was a real crummy time to do refinances. So what we kind of worked on was teaching those individuals, say, hey, listen, if money's not an option, because during that time, money was an option. And it always is, don't get me wrong about that, but the struggle was real. In today's world, there's some struggles, but it wasn't comparative to that during that time. So one of the things we coached people on was that, hey, listen, if you can make any type of extra payment to your mortgage, you can bring that rate down. Now, going back to that time period, looking where we are today, I'm constantly talking to consumers. I'm constantly talking to people that are like, if the rate is this, and we talked about it, if it's like 6.25, people are going to move. People are going to refinance because they'll use the adjusted point system on discounts to get down the 5s. They're going to feel good about themselves. They're going to refinance. But what if you could do something now and you don't have to worry about that time coming until it gets here, right? What if you could effectively do something now? Now, one of the things you have to consider in this conversation that we're getting ready to have is, hey, do you have any disposable income that you're aware of that you could use? Now, I find that term interesting because a lot of people go, Q, hey, listen, stuff's tight right now as it is. I would love to get the equity out of my home. Or, hey, listen, we're stretched thin right now between just life, right? There's just no extra room. So think about this. It's tax season is approaching. Now, one of the things I like to say is that as tax season approaches, I never count, nor should you count on a tax return as a part of your income. It should not. And I know that's hard to think about because a lot of people go, oh, hey, it's a bonus, I'm going to use it. But think about it as this strategy. And it's something that I started adopting probably about 10 years ago. And I started encouraging people to do is as you file your tax returns, and you're going to get a return, right? If you know that, right? Go ahead and start budgeting a portion of that return towards your mortgage. And I know that sounds odd, but it's amazing how you can actually control your own interest rate on your home as well as the interest that you're paying your lender by just making a little bit of extra payments. So on my screen here, and my producer will pull it up. And if you're watching this on YouTube or at What's Your One More with the number 1, that's at What's Your One More with the number 1. My screen's going to pull up here, and what I'm going to do is I'm going to create a mock mortgage, right? And what I mean by that is I'm going to pretend that this is a mortgage amount at $500,000, since that's roughly the average mortgage in our area. $500,000. I'm going to say it was a 30-year mortgage at a 7% interest rate, and I'm going to say time remaining on this mortgage was essentially 29 years, right? 29 years remaining. So it's year one in this mortgage. I've only made 12 payments. But what I want to do is that my current payment with my PITI on this property is about $3,326 because I didn't put much down on it, right? And so what I want to do is how much can I apply to this and still feel comfortable? So in this scenario, I'm going to apply $100 extra a month. So I'm going to take it from $33.26. I'm going to kick it up and add an extra $100, make it $34.26. So as you'll see on the screen, and we'll put the website in there, you can use this as well. This is a free tool. What I want to show you is that when I do that, what happens is in the top right-hand corner, you'll see that I shaved off 2 years and 6 months. So just add an extra $100 saved 2 years and 6 months from the 29 years. So now I'm taking it from 29 years to 26 years and 4 months just by adding an extra $100. Well, that extra 2 years and 6 months of interest that I would normally pay, that actually reduces the interest rate that I'm paying on that loan because I'm not paying that extra 2 years and 6 months. It also reduces the amount of interest that I'm paying. And you can see right here the total savings just in interest in 2 years and 6 months is $68,528.81, just on $100 a month for the remaining of the year, remaining portion of that term of the loan, right? And so the reality is we're always disciplined enough to make $100 a month. We're just not disciplined to do it all the time. So what if you stroke a $1,200 check at one time and said principal only? You took $1,200 out of your tax returns and said principal only. You're going to get the exact same outcome right here. So you actually have the opportunity coming up here in April when we file taxes, you file it before they may get your return, just apply it to your mortgage and you're going to get the benefits of all these things that we're showing right here. Now, I want to take it a step further. What if you can apply more than $100 a month, right? What if you had the ability to pay it off in an increment and say, well, you know what, I'm going to make an extra payment a year. So here's what I look at on here. So if I look at it and I go, well, let me kind of work through the numbers here. So I'm going to look at annually on here and I'll make an extra payment. So the extra payment is $33.26. So that's what I want to pay on the extra amount per year here. So broken down on that, $33.26. Let's go ahead and put that in here and see what it does here. I want to show you. So if I take $33.26, I'm going to divide that out here monthly and put it on here. $33.26. Put it on here. That's going to be an extra $277 a month. Watch what this does. This is where the real power kicks in on here, where you can control your mortgage by making that one extra payment and put it in there. Look, all of a sudden, wow, look at the savings on that. So your savings, you shaved off nearly 6 years by making one extra payment a year. Just one. That's incredible. Now, the lenders don't want you to do this. The lenders don't want you to make that payment. Why? Because you're saving $157,000. That's money that you would have given to them. Now, what's interesting is on here is that if you really, really start getting into this and you come across some additional pay raises or you come across some money that you inherited, maybe you get a large bonus, you can apply all that down. Now, if you can make over $10,000 in one payment towards the principal balance of one time, there's an option inside of your mortgage, and you need to speak with the mortgage servicer, the person you make your payment to. This is called a recast. And what you could do at this point is go to them, make a one-time payment of $10,000 or more after you've had the mortgage for at least a year and say, I would like to recast my balance. Now, at this point, you have 29 years remaining on this loan when you do that. But let's say you stroke a check. Let's say the loan amount's $500,000. And at that time, at 29 years, it's $500. You put a check down, and let's just say you've rented some money. You're going to say, hey, listen, I'd like to put $50,000 into this. You put $50,000 into that. Now you're at a balance of $450,000. You ask them to go in and recast that $450,000 over 29 years at the interest rate. Your principal payment comes down because now you're financing $450, not $500. But there's a lot of lenders that'll gladly accept that $50,000. They're not going to bring up recast. That's something that you're going to have to bring up when you talk with them. But it's worth it because the payment goes down. Now you can get a new payment, but continue making the old payment, and you can see what happens when you accelerate it right here. So I encourage all of our buyers. I'm like, hey, listen, at the end of tax season, when you get that, apply that balance. Just give one extra payment a year. You're going to save nearly 6 years on the property. And it's going to literally save you hundreds of thousands of dollars in interest, as you can see on this calculator here. Now, there's another type of product you can use called a bi-weekly payment. Now, this one's extremely popular because essentially you're going to make 12 payments a year traditionally. You make one every month. But what if you took that payment and cut it in half and said, every 2 weeks, I'm going to make a payment. So every 2 weeks, you're making a payment. So in this case, if the mortgage payment's $33.26, you're making half of that, which is roughly about 16 and some change, right? And you're making that every 2 weeks. Well, you're actually making 26 payments on the year, which ends up being 13 payments in total instead of 12. Well, the reason that's important is because you're paying it down monthly, quickly, faster. You're not taking one payment and stroking a check. You're actually paying it off quicker that way. And you'll see what it does in the next calculator that I bring up right here. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. Okay, so we're pulling up the graph here, taking a look at it. Again, if you're listening to this in the car, first of all, thank you. If you're listening to this on Apple or Spotify, jump over to YouTube. Check us out at What's Your One More Number One. Subscribe. Get all these graphs, get all these updates and things that we're talking about. And this is like an interactive chart that I have on here. You know, we're talking about biweekly payments. And, you know, I stress these because it's pretty simple to do. You take your mortgage payment. In this case, I was talking about the example we were using, the 7% interest rate loan at $500,000 on 30 years. You're taking that, which is a $33.26 payment, and you're cutting it in half, which is $16.63. And every 2 weeks, you're just making that payment of $16.63. And what you see is just the tremendous amount of savings and the amount of time you're taking off of that mortgage by doing it that way. In this particular case, by making a biweekly payment, like that's what you've done. You've done just effectively every 2 weeks. Your mortgage is now, instead of 30 years, is 23.7 years. And look at the amount of interest being saved here. It's over $170,000 on this loan. And that's powerful math right there. And again, you're not doing anything different. You're not refinancing. Yes, theoretically, you're making that extra payment, but you're doing it in increments that are a little bit more attainable. So why do it every 2 weeks? Well, that's because most people, according to ADP, get paid every 2 weeks, right? You either get paid on the 1st and the 15th, the 15th and the 30th, the 10th and the 25th. The list goes on and on, but you're getting paid in 2 week increments. So budgeting that paycheck, if you may, based on your mortgage payment really sets up a nice opportunity to shave a lot of interest and really lower your interest rate. Because again, the less interest you're paying on the loan, the lower that effective interest rate is on your loan. So that 7% becomes more like a lower 6s just by doing exactly what we're talking about. And I think that's a real powerful way to take control of your mortgage in this time frame when rates may not be where they, we all want them to be. They're going to get there, but they're not there now. But all you're doing is shaving off interest and cutting into the principal, and you're helping yourself. So when rates do get lower and you want to refinance, your LTV is going to be in a better position. That loan to value is going to be, lower, giving you more opportunity to get an even lower rate. And you're actually benefiting yourself because you're saving money. You're putting money back into your pocket on future payments that you don't have to make. And that's what we're trying to do here on this episode, as well as other episodes here on the podcast, is to give you guys value and education on things that I like to call our hacks in the mortgage world and hacks in the credit world that often aren't talked about. So real excited about that as we bring more to these show. Appreciate all the feedback you guys are giving us because it's driving us to do more episodes like this and more consumer advocate things that we can aim for on here. So we got a Fed meeting coming up in the next week. Obviously, that's like our Super Bowl of things around here this month. So we're going to be talking about that. What happens? I'm still holding true. I think we're going to get 4 cuts this year. We may not get in the month of January, but they're coming because there's 12 months and they meet 8 times. So we're going to see what happens here over the course, but I'm going to say more cuts are on the way. Looking forward to that. Also looking forward to the next episode. Guys, if you like what you're hearing, please share this podcast. If you would, tell a friend about it, tell a family member, coworker. Obviously we're here to help you guys. We love the feedback you're putting on our YouTube channel at What's Your One More. Keep the comments coming. They mean a lot. And like I said, they drive us to do episodes like this. So till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.